Liz, there is some optimistic news in this report. Inflation is going to drop in 2008. Unemployment is under control, won't go over 5%. And GDP, although it is slowing and going to be lower than it is right now in 2008, will begin to recover in 2009 and then recover again in 2010. This is according to the Fed's forward-looking projections. Let's get right to the first graphic with GDP. 1.8 to 2.5%. That's what they're projecting in 2008. That's a drop off of where we are right now. Remember, third quarter of this year, we were at 3.9%. The Fed predicting that we will hold it somewhere between 2 and 2.7% in 2009 and 2010. Then let's look at unemployment. Unemployment is going to remain, according to the Fed, below 5% for the next 3 years. This is a pretty significant number because essentially the Fed is striving for full employment, and you almost have it here. In 2008, they're predicting unemployment to be 4.8 to 4.9%. That is a slight increase over where we are right now. It'll hold steady in 2009 and then drop down a bit to 4.7 to 4.9% in 2010. Then let's look at inflation. This is crucial for every one of us, 300 million Americans. We are right now running at about 3% inflation. Next year, inflation drops to 1.8 to 2.1%. In 2009, we're looking at about the same, 1.7 to 2%, 1.6 to 1.9%. The bottom line on this, according to the Fed, is that inflation, this is everything in terms of inflation. Fuel, housing, everything you spend a penny on. Inflation is under control and actually dropping over the next 3 years. Now, as we take a look at the Fed's projections, there's some important quotes to listen to. And specifically, the Fed is concerned about the impact of the mortgage problems and the housing market on this economy. I want to read you the first quote we've pulled from the Summary of Economic Projections and hear what the FOMC is thinking. They say that the potential for a more severe contraction in the housing sector and a substantial decline in house prices was also perceived as a risk to the central outlook for economic growth. Now, this is key. This is what they're thinking about as we go forward because they want to keep full employment. They want to keep inflation under control. If you look at the previous meeting, the minutes from October 31st, you hear almost the exact same thing when they decided to cut the federal funds rate. The quote from that meeting on October 31st, almost exactly the same. The potential for significant further weakening in housing activity and home prices represented a downside risk to the economic outlook. That was their reasoning in part as to why they cut the federal funds rate 0.25%. The bottom line on this report, inflation not only under control, but the Fed predicting that inflation will drop. Think of it in terms like this. If you're averaging a 3% raise every year, you're going to be beating inflation according to the Fed. There's lots more in this report, David. I know that you and Liz want to jump into it, so let's have at it.
Adam Shapiro live from Washington. Adam just gave us pretty much the most important points here, and now we want to ask, what can we really learn from the Fed minutes as the Dow, the NASDAQ, and S&P all turn positive?
Let's go straight to our panel to find out. Independent trader Eric Bolling joins us, along with Charles Payne from WStreet.com, Mike Ozanian, national editor from Forbes, and Victoria Barrett, also from Forbes magazine, associate editor. So, Eric, first to you, bottom line, any indication as to what the Fed might do at their next meeting?
Well, you know, they gave sort of an innuendo recently that they may not move, and I don't think anything has really changed. The interesting part is this is a look back. This is, you know, a look back at data as of October 31st. Nothing has really changed. I don't see anything that's jumping out that says the world has changed dramatically, that they may go ahead and move. I think the Fed funds have priced in now an 80% chance of a move. Earlier in the week, or I'm sorry, earlier last week, it was up to 93% chance of a Fed move December 11th. This kind of tells me they may hold for at least this one, which is, by the way, I think is bad news for the market.
We also have Peter Schiff of Euro Pacific Capital and the author of Crash Proof. Peter, from what you've heard that Adam just announced from the Fed minutes, what do you think the Fed is going to do next? Not what you think they should do first, what you think they're going to do.
They're probably going to cut, but, I would take those minutes and throw them in a trash can. They don't mean a thing. The inflation is nowhere near 3% now. It's a lot higher, and next year it's going to be even worse. This is not information. This is disinformation. That's all the Fed does. They have an agenda. Their agenda is to try to create confidence in our financial markets, to create confidence in the dollar, but it's not going to work. We're in a real serious mess here, and it doesn't matter what the Fed says. We're not going to get out of it.
Well, the one thing, Charles, that we should point out on page 12 is Adam. Is Adam still with us? Adam Shapiro is not. Okay, Adam was telling us that on page 12 there's talk about a credit strain coming. They are concerned about a credit strain. Now, to me, that would mean if you're worried about a credit strain, that leaves a little room for lowering rates.
It leaves a little room, but you know, to Peter's point, I don't see where they try to make this all rosy or rose-colored glasses. If that was the case, we wouldn't have had the emergency rate cuts that we've had so far. But to Eric's point, I do feel like, okay, they are giving us somewhat of a forward-looking, more of a forward-looking projection than we had before. This is really fantastic news, the idea that inflation can be contained, so they do have to cut, then they have the elbow room to do so. But from what my initial reaction would be that they're not going to cut in December right now.
Mike, one of the things they said was they're worried about more severe contractions in the housing market, yet Ben Bernanke says, oh, it'll be over by spring of 2008. I'm sorry, I see the disconnect here. What's going on?
I agree with David. I'm not saying what the Fed should do, but if I had to guess what the Fed will do, and based on these minutes, I think the Fed is more likely to cut than not. The reason is that will help the banks out and the financial institutions the most. They make their money from the spread. They take the deposits, they pay out a low interest, the lower the better for them, and they lend out at long. So the greater that spread, the better it is for banks. And I think for the Fed right now, the credit crunch is their main priority right now, today.
And Victoria, this is your colleague who's against a rate cut. Am I right, Mike?
That's right. I'm not saying this is what they should do.
So he's reading the notes and suggesting there may be room for one, even though he's against one. What do you think?
Well, I think our issue here is that the dollar is really weak already, and any further cuts to interest rates could weaken the dollar further and eventually lead to inflation. You know, the Fed is trying to predict what's going to happen 6 months, a year from now, but the reality is it's very hard to tell. And inflation could really throw away a lot of the economic growth we've been seeing so far. That's my concern. I wasn't as concerned a couple weeks ago, but I'm starting to see that the housing debacle really threatens the overall economy at this point.
Eric, as we're looking at the markets here, the Dow is now down about 26 points. It had popped up just slightly in the wake of the minutes being released and when Adam kind of led people through that. But as you look at their prediction, the GDP won't really recover until 2010, above 3%. Does that worry you at all?
Well, no, because I think a 3% GDP in the U.S. is not bad. That's pretty darn good when you think about it. We have low inflation. Unemployment is running fantastic. Wages are going up. All things are...
By the way, they said lower. They said 1.8 to 2.6, so that's significantly lower than 3.
But that's okay. You know, I mean, we've had some robust years of growth. The last 5 years have been fantastic, north of 3%. This is okay. The market, the economy can take a breather as long as unemployment doesn't get out of control, as long as we have a tight labor market where wages go up and people continue to spend. This is okay. The rest of the world will continue to grow and make up for our lack of growth. This isn't a bad thing at all.
Hey, Peter, I'm going to throw you a big softball here. 2 words, or two companies, Fannie Mae and Freddie Mac. Freddie Mac is down 30% today. Fannie Mae is down 24%. Between the two of them, they hold about $4 trillion in these mortgage-backed securities and mortgages themselves. Does their crashing today, the stock crashing today, foretell something about the future in the housing market?
Well, it should. I mean, in my book, Crash Proof, of course, I predicted that both of these companies would go bankrupt, and I stand by that prediction. But this should be a bombshell. This should be letting people, the Pollyannas on Wall Street, who've been saying that this subprime thing is contained. These are not subprime mortgages. These are conforming loans that are going bad. And this is just the beginning. And remember, when Fannie Mae and Freddie Mac guaranteed these mortgages, they guaranteed trillions in adjustable rate mortgages where they only qualified the borrowers at the teaser rate. They didn't care about the resets, and the resets are all going to be coming in the next few years. And the real question should be, what about the implied guarantee? When these companies go bankrupt, is the government going to try to stand behind it? And if that's the case, this is going to make the S&L bailout look like a Sunday school picnic.
Well, maybe it took the markets a few minutes to really digest it and get indigestion, but